Hi everyone, I Ashish Nadesh on behalf of our group present the final assignment that we did as part of our course Business Finance, that is PMC150. This group presentation has been done by Tara Patadia, Prabhuwani, Ashish Naresh, and Humerapati. As per the problem, the Big Pharma Ltd invested $350,000 for developing a new type of insect repellent. The marketing manager estimates that the product will sell 170,000 bottles for the first year, 210,000 bottles for the second year, and 260,000 bottles for the next 3 years. The selling price of the bottle will be $6 for the first year, $6.99 for the second year, for the second and third year, and $7.95 for the next 2 years, that is 4 and 5. Also, there will be some variable cost and fixed cost which will be incurred by the organization, which are as follows. The variable cost will be $3 for the first year, $3.5 for the second and third year, and $3.75 for the fourth and fifth year. The fixed costs are expected to be $210,000 per year, which includes $165,000 additional fixed cost and $45,000 existing business fixed cost. These costs will increase by 5% each year. And to produce the repellent, a new machinery will be purchased by the organization, which will cost $650,000 and needs to be purchased immediately. The salvage value of the machinery after 5 years will be $150,000. The business calculates depreciation following CCA rules, and 50% rule is applicable on the same. The business has a cost of capital of 15%, and taxes are calculated at a rate of 35%. Given are the few assumptions that can be made from the problem statement. $350,000 is already invested for the new product development, so it is sunk cost and is irrelevant to the cash flow. $45,000 fixed cost from existing business is also sunk cost and is irrelevant. Using CC 50% rule, the depreciation is calculated at 50% for year 1 to 5. The given table represents the cash flow statement for the Big Pharmaceuticals Limited for the period of next 5 years. The first row shows the initial investment made by the company to purchase the new equipment. The next row shows the sales or the revenue generated by the company for the next 5 years. The next row shows the variable cost incurred by the company. Next row is the fixed cost which is incurred by the company and it is increasing by the rate of 5% per year. The next row is the capital cost of allowance, which is being calculated at the rate of 30% and 50% rule is applicable in the same. The next row shows the earnings before tax. After that, the income tax is calculated at the rate of 35%. And the next row shows the net income for the next 5 years. Next is the salvage value for the 5th year when we are selling the machinery. And from this we can infer that the book value of the machinery is less than the salvage value. So there's a gain on the sale of the equipment after 5 years. The next row shows the net operating cash flow, the discounting rate at 15%, and the present value for the next 5 years. So from this, we calculated the net present value of the whole project for 5 years, and it comes out to be 392,431, and the IRR is 36%, which is greater than the cost of capital for Big Pharmaceuticals Limited, that is 15%. So now we will be doing the sensitivity analysis on the project which is being done by Big Pharmaceuticals Limited to produce the insect repellent, whether they should go with the project or not. The first part in which we are doing the sensitivity analysis is the initial cost of the machinery, that is $650,000. We have done the sensitivity analysis for the 8 different values from minus 20% to plus 20%. So when initial investment is decreased by 5% to 20%, NPV and IRR both are increased. In all these cases, project will be financially acceptable, but when investment increases from 5% to 20%, both NPV and IRR decreases. When investment was increased by 20%, IRR value dropped by 8%. And also we can see that there is a continuous decrease in NPV and IRR when the initial cost is changed. So the next part of sensitivity analysis is done on the fixed cost. So we are calculating the NPV and IRR by changing the fixed cost from -20% to +20%. So from the chart, we can see that the NPV is continuously decreasing if we are changing from -20% to +20%, and also is the scenario with the IRR. But still, the NPV is in positive, so we can go with the project, and also the IRR is above the cost of capital of Big Pharmaceuticals Limited, that is 15%. So the next sensitivity analysis is done on the variable cost. So for the NPV, we can see that there's a huge drop of NPV from -20% to +20%, but still it isn't positive. So we can go with the project. Also, the IR value is being continuously decreasing from -20 to +20%, and approximately +15 to 20%, it comes out to be a little bit stable. So there's no huge drop on IR, but NPV is hugely dropping and variable cost is changing. So the next part is for the price per bottle, and this is a little bit interesting as compared to the initial cost, the fixed cost, and the variable cost. Because when we were decreasing the cost by -20%, the NPV was rising hugely. But here it is a different scenario altogether. Here, if we decrease the cost by -20%, the NPV is in negative, and if then we increase the cost of bottle, the NPV is rising at a huge rapid rate. So that is pretty much interesting, and still the NPV is positive for most of the values, so we can go with the project. And also the scenario with the IRR. Here also the IRR is less for the -20% decrease, and if we are increasing the value, the IRR is increasing on a continuous rate. The next part of the sensitivity analysis on the residual value, that is the salvage value of the equipment. For the NPV, we can see if we are decreasing the cost by -20, it is the lowest, and when we are increasing the values, the NPV is constantly increasing. And also, there is no change for IRR, so this comes out to be pretty much interesting, because for each of the changes that we were making in the initial cost or the fixed cost or the variable cost, the IRR was continuously either dropping or increasing. But in this scenario, it is constant and there is no changes in the IRR. So the next part of the sensitivity analysis is for the all values that we have changed till now. That is initial cost, fixed cost, variable cost, price per bottle, and the residual value. So we can see, so if we are decreasing the value from the base value, that is -5% or -10, -15, 20%, the NPV is constantly increasing. And if we increase the initial cost, fixed cost, variable cost, the NPV is constantly decreasing. And for the price per bottle and the residual value, the NPV is increasing. And in the final comparison for all the values, we can see that that for decreasing the base value, the NPV is decreasing, and for increasing the base value, the NPV is increasing. But still, NPV is in positive, so there is no second thought of dropping the project. So this chart represents the NPV change for all the values. For the initial cost, we can see if we are decreasing the value, the NPV is increasing, and if we are increasing the value of the base price, the NPV is decreasing. And it is the same scenario for fixed cost. If we decrease the base price, the NPV is increasing, and if we increase the base price, the NPV is decreasing. And for the variable cost, it is also the same scenario, but in the variable cost, we can see that the NPV is decreased by a huge rate when the base price of the variable cost has increased. But for the price per bottle, the NPV is increasing if the base price is increased, and it is being decreasing if we reduce the base price. And there is no change for the residual value. And for the all, if we include all the changes, we can see that by decreasing the base value, the NPV is decreasing, and if we increase the base value, the NPV is increasing for all the above values. So this table represents the IR comparison for all the values. So for the initial cost, if we decrease the base value, the IRR is constantly increasing. But if we increase the initial cost value, the IRR is decreasing. But still, it is greater than the cost of capital of Big Pharmaceuticals Limited. And same is the scenario with the fixed cost. If we decrease the base value, the IRR is increasing, and if we increase the base value, the IRR is decreasing. The same is the scenario with the variable cost. If we decrease the variable cost by base price, the IRR will increase, and if we increase the base price, the IRR will decrease. But for the price per bottle, and the it is altogether different scenario. By decreasing the base price, the IRR is also decreasing, and by increasing the base price, the IRR is also increasing. And for the residual value, there is no change in the IRR. It's constant for all the values if we are decreasing or increasing the residual value. And last is for the combined all value changing. If we decrease the base price, the IRR remains to be constant, and for increasing also it is constant. So there is no change in IRR if we are altogether uh, increasing or decreasing the all values. So this is the graphical representation of the IRR change that we saw in the previous table. So for the initial cost, it is constantly decreasing. For the fixed cost, it is decreasing. For the variable cost, it is decreasing. But for the price per bottle, it is continuously increasing. And for the residual value and all values combined, it is constant. So there is no change in residual value in all combined values. But for the price per bottle, it is continuously increasing. So now from the problem statement and from the sensitivity analysis that we did on the project, we can conclude that the investment proposal has a positive net present value of 392,431 and is therefore financially acceptable. The result of other investment appraisal method do not alter this financial acceptability, as NPV decision will always offer the correct investment advice. Also, the IRR method recommends that we accept the investment proposal since the IRR is 36% and it is greater than the 15% return required by the Big Pharmaceuticals Limited. The sensitivity analysis also results in a positive net present value for all the different varied factors. So, the Big Pharmaceuticals Limited should proceed with the project. And also from the analysis, we can see the NPV can have a growth of more than 100% of the base price if the price of the bottle is increased. So, company can look at this aspect to increase the overall profit of the organization. Thank you.